Fiscal policy is one of the major demand management policies that is used to manage aggregate demand of an economy. Government's fiscal policy is its plan for spending and taxation. Thus, fiscal policy is the exercise of the government's control over public spending and tax collection for achieving the objectives of general economic policy. Specific objectives are many, but the general objective is to control the unemployment and inflation. Tools that are used to execute fiscal policy are called fiscal instruments. And these instruments vary from economy to economy. But there are some instruments that are commonly used by all economies. The major instruments that are used to control over public spending and tax collections are government spending, tax rate, transfer payments, and investment subsidy. Fiscal policy can be of two types: expansionary fiscal policy and contractionary fiscal policy. Let us now see what is expansionary fiscal policy. When the fiscal instruments are used to expand or to stimulate the economy by stimulating aggregate demand is called expansionary fiscal policy. Now, we shall examine how the fiscal instruments are used to execute an expansionary fiscal policy. Government can increase government expenditure to execute an expansionary fiscal policy. When government expenditure is increased as a component of aggregate demand, it will increase the aggregate demand as well. Government can implement an expansionary fiscal policy by cutting tax. When tax rate is reduced, it increases consumers' disposable income. And from the study of consumption function, we have come to know that when disposable income rises, consumption expenditure rises. And when consumption expenditure rises, aggregate demand rises as well. If government spends more on transfer payments, it will increase aggregate demand by increasing disposable income and thereby consumption expenditure. Government can increase investment subsidy to stimulate investment spending, which will ultimately stimulate aggregate demand. These are the four possible ways that government can follow to execute an expansionary fiscal policy. Let us now see what is contractionary fiscal policy. When the fiscal instruments are used to restrict the economy by squeezing aggregate demand is called contractionary fiscal policy. Government can execute a contractionary fiscal policy managing the instruments of fiscal policy in the following way. First, government can reduce government expenditure. If government expenditure is reduced as a component of aggregate demand, it will reduce aggregate demand as well. If government increases the tax rate, it will reduce the disposable income of the consumer, which will reduce the consumption expenditure of the consumer, and thus it will reduce the aggregate demand. Government can reduce the transfer payments. If transfer payment is decreased, disposable income falls. As a result, consumption expenditure falls, and ultimately aggregate demand falls. Decreasing investment subsidy, government can discourage investment spending and thereby aggregate demand. These are the four possible ways following which government can exercise a contractionary fiscal policy. As like fiscal policy, monetary policy is also used to manage aggregate demand. Fiscal policy is executed by the government, but monetary policy is taken by the central bank. Monetary policy is the exercise of central bank's control over money supply as an instrument for achieving the objectives of general economic policy. The objectives of general economic policy are to control inflation and unemployment. Central bank of an economy uses certain instruments to control money supply, known as monetary instruments. We shall discuss some of the major instruments that are used to control money supply. First, open market operation. Open market operation refers to the purchase and sale of government securities in the open market by central bank. It is an important tool to control money supply. If central bank wants to reduce money supply, it sells securities in the open market and thus withdraw money from the economy. Similarly, if the central bank desires to increase money supply, it purchases securities from the open market. The second instrument is required reserve ratio. All the commercial banks are to maintain a minimum reserve with central bank on their deposits. The rate at which the reserve is maintained is called required reserve ratio, which is fixed by the central bank. If the required reserve ratio is increased, it means commercial banks are to maintain more reserve on deposit, and thus availability of fund of doing business will fall, which refers to fall in money supply. And if central bank reduces required reserve ratio, commercial banks can utilize more fund and money supply rises. Finally, bank rate. Central bank can influence money supply changing bank rate. Bank rate is the interest rate that the central bank charges on loans that it makes to commercial banks. If bank rate is increased, it demotivates the commercial banks to take loan from the central bank and money supply falls. Similarly, central bank can influence the commercial banks to take more loan by reducing the bank rate and thus money supply rises. These are some common instruments that are used by the central banks to control money supply. Based on the use of these instruments, monetary policy can be of two types: expansionary monetary policy and contractionary monetary policy. Let us first see what is expansionary monetary policy. When monetary instruments are used to expand or to stimulate an economy by stimulating aggregate demand, raising money supply is called expansionary monetary policy. That is, in this case, monetary instruments are used so as to increase money supply. To execute an expansionary monetary policy, central bank buys government securities in the open market. As a result, money supply rises. Central bank can reduce required reserve ratio. It will increase the availability of funds to the commercial banks to do business, and money supply rises. Similarly, central bank can influence the commercial bank to take loans from the central bank, reducing bank rate, which will ultimately increase the money supply. Contractionary monetary policy. In this case, monetary instruments are used to restrict or to shrink the economy by squeezing aggregate demand, reducing money supply. In this case, monetary instruments are used in such a manner that they reduces money supply. To exert a contractionary effect in the economy, central bank can sell government securities in the open market. When government securities are sold in the open market, it reduces money supply. Similarly, central bank can increase required reserve ratio. It will reduce the availability of funds to the commercial banks to do business, and money supply falls. Finally, central bank can increase the bank rate and thus demotivate the commercial banks to take loan from the central bank, which will cause a fall in money supply as well. These are the three possible ways following which central bank can reduce money supply of an economy.